Thank you for your continued patronage and thanks for joining in such good numbers. So today's topic, as the title suggests, it's buyback, a strategic decision. So this itself signifies the importance that we attribute to this topic itself, buyback. While we all know buyback is a way where you buy a company buybacks its shares, and there are a lot of factors which actually contributes towards a buyback. Predominantly, it's a way to incentivize your shareholders, but there are a lot of other benefits which are connected with buyback, like increase in shareholders and all, way to avoid hostile takeovers, improve earning per share. So there are a lot of things which one should consider in mind before opting for a buyback. Buyback, in comparison to dividend, which is the most common method of incentivizing your shareholder, is also more tax efficient, because while dividend is directly taxable in the hands of a shareholder, buyback is taxable in the hands of the company only. So there were talks before this budget that government may bring both at par in terms of taxation. So similar to dividend, buyback will also be taxable in the hands of the shareholder. But as of now, the status quo remains, and buyback continues to be taxed at the hands of the company only. So today we are here again to discuss this important topic, to discuss the nitty-gritties connected with this proposal of buyback. When should companies decide the right time to go for a buyback? What are the intricacies which are connected with this process? Taxation impact, and a lot of other things we will be discussing today as part of this webinar. And as always, we have a wonderful panel with us today to discuss this important topic. Starting with Dr. R.K. Agarwal. You must have seen him as a panelist in our earlier webinars too. He's a seasoned professional and eminent expert in the field of taxation, finance, accounting, partner of Rakesh and Associates, and also a mentor at corporate professionals. I welcome you, R.K. sir. Then we have Ms. Anjali Agarwal, a regular appearer on the webinars. She's partner at Capital Market. Then we have Mr. Manoj Kumar, again partner head M&A and transactions at corporate professionals. Then we have two young buddies of our firm, Mr. Tushar Shukla and Ms. Charu Gakar. Tushar is a manager at Capital Market, and Charu is also assistant manager. They both work along with Anjali. And then we have me to host you this webinar. Mr. Pawan Vijay couldn't attend this webinar today because of some other exigencies. So to start with how this program is structured, we'll begin with a presentation on the topic, where we'll discuss the important points as we discussed initially regarding the procedure, intricacies, other important issues. Then after we'll move to Dr. R. Kumar Agarwal to hear his perspective on the various tax-related intricacies connected with this entire topic. And then Manoj will add his own view in terms of how to manage a buyback, what are the other factors one should consider. So let's start with this topic. I'll request Ms. Anjali and Tushar and Charu to begin their presentation, and we'll take that thereafter.
Charu, we can start the presentation. Good evening, friends. We once again welcome you to a very, very important topic in the present scenario, buyback of equity shares. In our experience of handling the listed companies, we have seen that buyback is one of a very important strategic decision which managements take on one of the ways to return value to the shareholders, and the other way to as a tax efficient method to return the value. Charu? So buyback, as the name suggests, buy back. That is, you're buying back something, which is share repurchase. You're repurchasing the shares of the company. Your outstanding shares get reduced to that extent, and accordingly, the number of shares available in the market also get reduced. Now, as I told you that during the present scenario, buybacks is on an increasing trend. If we look at the number of buybacks during last 2 years, as if we look in abstract numbers, the number of buybacks have increased from 40 to 64 between 21-22 to 22-23. However, the financial amount involved therein has reduced from 31,000 crores to 22,000 crores. There can be varied reasons to it, but the number of buybacks is on an increasing trend. These are some of the recent companies which have come out with buyback. This includes this chart includes at what price the companies have come out with buyback. For example, if you look at Symphony, it came out with a premium of 90%, then 34, 34, 32, 31. Godavari Team Lease presently is going on at 31%. Charu? Windlass is currently going on at 28%. Likewise, and KDDL came out with a premium of 12%. So we can understand that there are companies which give a premium of even 90% on the running market prices. So there is no fixed criteria of deciding upon the price. It can be decided by the managements depending upon the funds available with them, depending upon the assets that they have to liquidate to be able to return value to the shareholders, and accordingly a premium may be decided. A very prime question that comes to anybody's mind is why buyback? If I have a particular capital which is there in my balance sheet, what is the need as to buying it back and reducing the share capital? So there are various reasons pertaining to it. Most important reason that comes to everybody's mind, that it improves the financial ratios, in the sense, since my equity base gets reduced, accordingly, obviously my numbers, the denominator gets reduced and the ratios as in EPS or return on capital gets improved. Then it supports the falling market price. This we have seen. For example, if I take the case of Paytm got listed at a very high price. Post IPO, the price was not to that level, and the promoters felt and the management felt, there is no promoter in that company, and the management felt that we need to support the falling market price. So they came out with the buyback just within 1 to 2 years of their listing, just after 1.5 years of their listing. It provides liquidity to the investors. It provides an additional route to the shareholders when the shares are undervalued or thinly traded. If a particular script, I feel the market, I being the promoter or management, if I feel that the value should be 200 rupees, whereas it is being traded at 90 rupees, 100 rupees, the buyback can be a better alternative to give support to that undervalued script. To enhance consolidation, in a buyback, the promoters have an option to tender their shares or not to tender their shares. If a promoter decides not to participate in the buyback, it will ultimately lead to increase the number of shares will remain the same, but his percentage holding will increase. Accordingly, it leads to a consolidation of shareholding. Tax implication, dividend is taxable in the hands of the shareholders depending upon the person's tax slab. But in the case of buyback, there is no tax implication. Presently, there is no tax implication in the hands of the shareholders. It is taxable. The company is needed to pay a tax on it. We have Mr. R.K. Agarwal with us. He'll be taking up the taxation aspects in detail on various aspects. Then returning cash to the shareholders to optimize the capital structure. Many a times the promoters company feels that my capital structure is too big and I may not be in a position to serve the capital. So they decide to come out with buyback and accordingly reduce the capital structure and to serve the equity in a better way. But these are all academic reasons. Even if somebody will Google that as to why a company does a buyback, as on date ChatGPT, even that will tell all these reasons. But practically, when we talk to the companies, there are varied reasons involved in a decision as to why should company come out with a buyback. In one of the cases, we found that there were two sets of promoters, wherein one of them wanted an exit. So if any of the promoters would sell a huge chunk in the market price would collapse. So accordingly, they decided to come out with a buyback, wherein one of them could have taken the exit route. One of the other cases wherein we came out was the company came out with the IPO recently, and one of the anchor investor wanted an exit. Again, anchor investor was holding a major chunk. If he would have sold in the market, the price could have fallen down. So the company decided to give an exit to the anchor investor. Another interesting fact that came to us, case that came to us was it was promoters' son's marriage 6 months down the line, and the promoter wanted a cash flow in his hands. So accordingly, he decided, okay, to get a salary, there is a limitation, only up to a particular level they can draw the salary from the company. So they decided that, okay, we can come out with a buyback. And these are some of the practical reasons as to why companies come out with buyback. These are not available anywhere in the books, but these are some of the practical reasons. So improving financial ratios, my assets get reduced, my equity get reduced. So accordingly, my return on assets get increases, return on equity increases, EPS increases, and thus it improves the company's PE ratio. Shareholding consolidation. When we talk about shareholding consolidation, as I discussed in the previous slide as well, the promoter holding, if the promoter does not participate and only public tenders the shares, so accordingly, my promoter holding will increase with my numbers remaining the same and voting percentage getting increased. Tax efficient, I've already explained that buyback is a more tax efficient route in the hands of the shareholders. It's tax free and it provides liquidity. Important points that the managements generally ask us, what would be the impact on my balance sheet? So my capital gets reduced by the face value of the numbers that I buy back. Then accordingly to that tune, my assets also get reduced by the entire book value. My reserves get reduced by the premium of the book value, and an equivalent amount of the face value is transferred to the capital reduction, transferred to capital redemption reserve. Impact on insider trading regulations. This is one of the most important regulations these days. Presently, SEBI as well as all the regulators are very much concerned about the PIT regulations. And the most important aspect of PIT regulations is trading window, number one. Number two, the contra trade provisions. So as per the guidance note and FAQs issued by SEBI, trading window provisions are not applicable in case of a buyback because it is an offer being made to all the shareholders. Likewise, in case of contra trade, there is an exemption available to the designated persons, wherein if somebody has bought any shares during preceding 6 months, they can tender the shares. But likewise, opposite transaction cannot be undertaken, wherein after the tendering of shares in the buyback, for next 6 months, they cannot purchase any shares from the market or by way of further acquisitions. Now, impact on takeover regulations. Takeover regulations, the transactions are exempt under the provisions of takeover regulations. Any shareholding increase pursuant to a buyback is exempt. But with regard to regulation 3(1), that is increase in shareholding beyond 25% individually or collectively, the concerned promoter have to bring down the shareholding within a period of 90 days. Then it will not be considered as triggering. Likewise, in case of 3(2), that is increase of creeping acquisition of increase of shareholding of more than 5%, there are certain conditions which have been prescribed under the takeover regulations, pursuant to which the exemption is there, wherein one of the most important condition is that the concerned promoter should not have voted in favor of the resolution, and the shareholders approval, if the case is, then it has to be obtained by way of a postal ballot. EGM is not permissible in this case. It has to be obtained by way of a postal ballot. Now, the legal framework, the two important regulations or acts which are applicable is the Companies Act and the SEBI buyback regulations. As per the SEBI buyback regulations, there are broadly two methods of modes of buyback. One is the tender offer route. The other one is the open market. Open market, again, it can be either through the book building route or through the stock exchange route. Book build route has been there in the regulations for a very, very long time, but they were never ever used by any of the companies. Stock exchange is a common method which is generally used by the companies to do the buyback. But with effect from 9th March of this year, there have been made overhaul changes in the regulations, pursuant to which stock exchange mechanism is about to be done away with in a phased manner, and and SEBI has streamlined the modes as regard to the book build buyback through the book building route. Now, when we talk about these three modes, a question that comes to the mind as to what is the difference between the three modes. First important question aspect is promoters participation. Promoters can participate only in a tender offer route. They cannot participate in any of the other modes. Board approval or shareholders approval is required in all the three cases, depending upon whether under which up to which percentage we are doing the buyback. Public announcement is needed to be made in all the three modes. Then filing of draft offer document with SEBI or SEBI approval. Up till 9th March 23, SEBI approval was required in case of tender offer buybacks, but now they have done away with that requirement as well. Now no offer document is needed to be filed and no SEBI approval is needed even in case of tender offer. Fixation of record date is needed to be fixed in case of a tender offer route, but in case of exchange routes, open market routes, the record date is not needed to be fixed. Likewise, final letter of offer to be sent to the shareholders. It is needed to be sent in case of a tender offer route, but in case of open market routes through the stock exchange or book build method, the letter of offer is not needed to be sent to the shareholders. Tendering period till 9th March, it was 10 working days. Now this period has been reduced to 5 working days. And in case of stock exchange route, otherwise the open market buyback was open for a period of 6 months. Now this period of 6 months has been reduced with effect from 1st April 23 to 66 working days, and with effect from 1st April 24 to only 22 working days, and with effect from 1st April 25, it will not be allowed. Book built method, it's not 15 to working days. It has to be remain open for minimum 2 working days. The company has an option to increase it, extend the period, but as per the regulations, it is only 2 working days. Offer opening period, 4 working days from the record date in case of tender offer as well as through the stock exchange. Book build, it's not there. Separate trading window to be obtained from the stock exchanges. Now it is a requirement under all the three modes of buyback. Earlier, it was not required in case of tender offer, in case of open market buyback, but now it is required in all the three. Reservation for small shareholders. In case of tender offer, 15% of the number of shares proposed to be bought back is to be reserved for the small shareholders. But in case of open market buybacks, this requirement is not there. Revision in buyback price up till the recent amendments, that is 9th March, there was no possibility of any revision, any sort of revision. But now SEBI has permitted a revision, upward revision in buyback. This upward revision can be only in the sense that your total buyback size will remain the same, but the numbers will get reduced. As a result, there will not be any impact on the total buyback size. Obligation as to completion: in case of tender offer, there is no obligation as to offer completion. If you come out with a buyback of 10 lakh equity shares, and the public tenders only to the extent of 1 lakh within those 5 working days, that would be permissible. But in case of open market buyback, at least 75% of the amount earmarked for the buyback is needed to be utilized. So if you have decided to come out with a buyback of 10 crore, you have to at least use the amount of 7.5 crores, and at least 40% of the amount should be utilized within the first half of the specified duration. So when I talk about specified duration, as I told in the previous slide, presently, the open market buybacks are open only for 66 working days, and from next financial year onwards, they would be open for 22 working days. So that means 40% used to be utilized within 31st 33 days, and 40% to be utilized from next financial year onwards in the first 11 trading days, which is a difficult proposition. 11 working days, 22 working days is a very, very difficult situation. What we see in our practical experience, the present 75% condition is also not utilized in many of the cases in the entire 6 months window. So using this 40% during the first half may be a difficult proposition for the companies.
So any solution for this?
Ankit, we'll have to follow the book build method.
Okay.
And that is what SEBI wants.
They want to motivate this.
Yeah. Actually, what was happening in stock, as to what is the reason of doing away with the open market, what was happening, companies used to declare the buyback price at, say, 500 rupees. Running market price is 400. They would declare the buyback price as 500 rupees, whereas they would do the actual buying at or around the running market price. So that 500 rupees was actually eyewash, and public was not getting that 500 rupee ever. So public was getting only 400, 405, 407. So that is why SEBI has decided to do away with this method and encourage or promote the book build method. Now, quantum of buyback. If a company is doing buyback only to the extent of 10% of the paid up capital and free reserves, it can do it through a board resolution only. Shareholders approval is not required. But if it is decided to do anything more than 10%, even if it's 11%, subject to a maximum of 25% of the paid up capital and free reserves, a special resolution is also needed to be obtained from the shareholders, subject to the condition that a maximum of only 25% of the total paid up capital in the current financial year can be bought back. So both the conditions have to be looked at: 10% of the net worth, or up till 25% of the net worth, subject to a maximum of 25% of the paid up capital. In case of buyback through the open market, I've already discussed up till 31st March 2023, this limit was 15% of paid up capital and free reserves. With if up till 31st March 24, this 15% is being reduced to 10%, and up till 31st March 25, this 10% is further being reduced to 5%. And beyond that, open market buybacks will not be there. Stock exchange buybacks will not be there. Now, just a brief as to the activities involved in a tender offer buyback. The company has to appoint the manager to the offer plus other intermediaries, board approval or shareholder approval, whichever route the company is going ahead with. Newspaper publication is to be made, public announcement is to be given. The funds have to be deposited in the escrow account. Earlier, between these two stages, SEBI approved filing of draft letter of offer with SEBI used to be there, and SEBI approval used to be there, but now it has been done away with. Then dispatch of letter of offer to the shareholders. tendering period or to be opened only for 5 working days. Once the tendering period is over, deposit of funds in the special account, then payment to the shareholders is needed to be done. Then post-issue advertisement, extinguishment, and post-issue report is needed to be given to SEBI. When we talk about the open market buyback, merchant banker appointment is still required. There also a merchant banker is required. Shareholders approval or board approval, whichever route we are going ahead with, that is common. Public announcement, that again is common. Procurement of a separate window from stock exchange. This earlier was not required in an open market buyback, but now it is needed to be taken. Buyback to be initiated. Board meeting for closure of the buyback. Buyback can be closed. Open market buyback can be closed either within 6 months, or if the company achieves the maximum buyback size, it can close it. Then under an open market buyback, we have to do a daily settlement reporting during the entire buyback period. Post-issue advertisement is needed to be given. Shares are needed to be extinguished within 7 days of the expiry of buyback period, and a post-issue report is needed to be given. Charu? Now, again and again, I've been telling that with effect from 9th March, there have been this change, there have been that change. So 9th March, with effect from 9th March, there have been some overhaul changes in the entire buyback regulations, in the entire system of the way the companies have been undertaking the buybacks. So these are some of the amendments which have been made effective with effect from March 23. Charu will be taking over these amendments. Over to you, Charu.
Thank you so much, ma'am. Good evening, all of you. So, taking the PPT forward, we would be discussing the amendments which have been notified from March 9th. So, in general, the amendments we have categorized those in some parts. Some general amendments as to the regulations they have introduced the definition of frequently traded shares and secretarial auditor. Some clarification have been brought in calculation of limits for buyback. So we used to calculate the limits through standalone or consolidated balance sheet on standalone or consolidated basis, and now they have clarified that whoever sets a lower amount, that has to be taken. We used to take the lower amount only, but the same has been now clarified in the regulations itself. The next point is prior consent of lenders is required to be obtained. We used to take the consent of lenders prior as well because of some limitations in the lenders agreement the companies used to have, but the same was not specified in the law. Now they have specifically mentioned that prior consents have to be taken, and the this fact of consent has to be mentioned in the letter of offer as well. The next amendment is with regard to escrow account. Now, escrow account has to be opened within 2 working days of the public announcement. Apart from that, some general announcement where some general amendments wherein they have standardized the timelines throughout the regulations. Earlier, in the regulations, somewhere there were days and somewhere there were working days, which used to create a very, that was so tough for us to move forward. But on our suggestions, they have made the working days, they have made it throughout the regulations. Moving forward, so in case of buyback through tender offer routes, so first amendment is wherein they have allowed upward revision in the buybacks. In this, we can revise the price and we can decrease the number of shares. In lieu of that, उतना ही बायबैक वी कैन डू जितना बोर्ड या शेयर होल्डर्स से हमने अप्रूव कराया है, बट इन व्यू ऑफ अगर हम प्राइस इंक्रीज कर रहे हैं तो उस हिसाब से नंबर ऑफ शेयर्स वी कैन डिक्रीज, एंड दिस इज अलाउड बिफोर द रिकॉर्ड डेट ऑफ द बायबैक इज buyback is happening. The next is no SEBI approval. Now, as explained by Anjali ma'am, prior we have to file the draft letter of offer with SEBI. Then the SEBI approves. Then the SEBI used to approve it, and then we used to dispatch the letter of offer to the shareholders. But now they have made it the direct route. After the public announcement, directly letter of offer has to be dispatched to the shareholders. The next amendment, wherein they have reduced the time period of tendering period from 10 working days to 5 working days. Another concept wherein the extinguishment certificate was required to be signed by statutory auditor of the company. Now they have introduced the concept of secretarial auditor instead of statutory auditor, and wherever whether in case of tender offer or in case of open market buybacks, the extinguishment certificates have to be signed by the secretarial auditor, and rest that has to be signed by 3 more parties, that is manager to the offer and 2 directors of the company. Moving forward in buyback.
Charu, can we go back to the previous slide?
Yes, ma'am.
Yeah. So when we talk about allowing the upward revision, as to why this concept has been brought in is important to understand. There were certain cases wherein by the time the buyback used to open, the running market price used to reach almost the level of the buyback price, as a result of which the buyback price was becoming infructuous. And SEBI received various suggestions from various market participants that this revision should be allowed. So SEBI, that is where SEBI came in, this upward revision wala provision came into picture, as to that buyback size will remain the same, but upward revision in price is permissible. Continue, Charu.
Thank you, ma'am. In buyback through open market, now they have mandated that the companies which are frequently traded, only those can proceed with open market. And as discussed earlier, this method is going to be eradicated in a phased manner. And with effect from 1st April 2025, this won't be allowed. So how the phases would be like, till March 31st, 23, 15% is allowed. Then till March 31st, 24, 10%, and then 5% thereon. And then the same, the process would be completely eradicated. Now, earlier we used to, the regulation specified that 50% of the amount that was earmarked for buyback has to be utilized mandatorily. But for now, they have increased that limit to 75%. Apart from that, a minimum of 45% has to be utilized in the first half of the offer period. Now another amendment which is there is, we used to take a separate acquisition window in the tender offer. It was already there, but now for the open market cases also, till the time they are there, we have to take the separate acquisition window from the stock exchanges. Moving ahead, there were provisions with regard to buyback through book building process. Now they have streamlined the process in the regulations, and the process has been completely revamped. We would be discussing the process in the next slide. The major point which relates here is the promoters along with their associates, they cannot participate in the buyback through this method. How the book building buyback would be proceeded with: board and shareholders approval, thereafter public announcement. Then in this case, we have to email and SMS to shareholders as well. Then intimation to stock exchanges, offer opening announcement, offer closure announcement. Then we have to make payment to shareholders. In this case, the offer closure only, it would be open for only 2 trading days. The main thing which herein is the price. The herein we don't keep on the price which is fixed in the shareholders meeting or board meeting. There is a price band. So the price which is fixed in the shareholders meeting or board meeting, that is the upper price band, and the lower price band is to be determined through the like we have to see if the company is frequently traded, then there is different method for determination of lower price band, and if it is infrequently traded, then valuation report has to be obtained. So these were the amendments which have been there in the recent past. So now I would be handing over the PPT to Tushar. Tushar, please.
Thanks a lot, Charu. You explained it really well. First of all, I want to express my regards to the learned experts with whom I'm sharing this platform. So coming to the point, buyback as a strategy. So first question comes whenever the management wants to return value to its shareholders, there are many methods to it. There are bonus, there is buyback, there is dividend. But if we talk about buyback, the first question comes: why it should be done through the buyback? So it has been very well answered by Anjali ma'am. So coming to the next question, which comes to the management's mind, if we see it through management's perspective. So can we go to the next slide, please? So the first question comes is at what price I should do the buyback. So on a journal in the market, we have seen that buybacks happen at a premium of somewhere around 25%, and we have seen cases where buyback were done at a premium of 80 to 90% also. So these are the journal market trends, but there is one more key decisive factor. So if I'm doing buyback, the company is doing buyback, it is utilizing its cash, its investments to do buyback. So these funds were employed somewhere else and earning money to the company, and now company is utilizing this cash for doing buyback. So the ultimate return I'm having after the buyback on my, because of multiple reasons I'm doing it, should be more than the investment returns I was getting on these investments. So the price should be decided accordingly, keeping this in mind. Now the second question comes is the quantum of buyback. How much amount I should use out of my reserves for the buyback. So there are multiple factors which should be considered before deciding the quantum of buyback. In fact, not just the quantum of buyback, just deciding the quantum of amount we should return to the shareholders. So these are factors which are future capex, capital consolidation the management desires to do, expected future stability, and tax factors. To explain these further, by the way, these limits are to be in accordance with the regulatory limits of 25%, 10%. So explain it further, future capex. In the company, the management sees that in the following financial years, they are seeing lots of return and cash flows and new business and expansions are going to come, and the company is going to do good. So they can see the existing big promoters and the big strategic investors can try to do a buyback so that other shareholders can take an exit and they can take advantage of increasing their own value. And through this unbiased approach of doing the buyback and capital consolidation, again, there can be some shareholders, small shareholders, and some shareholders which are doing volatility in the market. So the big shareholders, the promoters, the strategic investors can use buyback as a strategy to give exit to these shareholders at a reasonable premium, so that there can be a consolidation in the shareholding, and they can the company can cater to loyal shareholders who wants to stay longer with the company and stay invested. And future stability the company is seeing. For example, the company makes a strategy of doing buyback periodically. So maybe they have 100 crores to do the buyback, but what if the company is doing 100 crore buyback every year, and maybe in future they don't see that we will be having 100 crore reserve, then they will do a 10 crore rupees buyback. So that will send a negative image in the market. So if they want to do a periodic return through buyback, they should decide their quantum in a manner that they have reserves always to do the buyback not utilize all the reserves, but some of it, and part of it next year, part of it next year. And like everybody as an individual also, and the corporates also, always try to keep some emergency cash. So I should not be utilizing all my reserves, because I need reserve for my capex purposes, for my working capital purposes, for my for utilizing for the returning value to the shareholders. And maybe they can some emergency come, the market can go haywire, the business can go haywire, the profit may dip, the cash flows may dip. So in that case, we need to decide the quantum accordingly. Next slide, please. Should the promoters participate or not? That depends on the, it is a very subjective approach. For example, like we said, the future growth plans of the company. For example, your the company is earning 100 rupees and there are 10 shareholders, each one is getting 10 rupees. So they do a buyback of 5 shareholders are gone away with the buyback. Now each shareholder is getting 20 rupees each, but that is a mechanical increase of the per shareholding. If the company is seeing future gains, the future revenues, the future profits will be divided into lesser shareholders. So this is a connectivity of the future growth plan with the deciding the factor that promoter should participate or not. And again, as Anjali ma'am said, if the promoter want to crystallize their investments, then they must participate in the buyback. Then they could also sell in the market, but it should not be done, because it's gonna send a negative signal in the market, and the share price could tank because of that. And next slide, please.
Tushar,
Frequency of buyback.
Tushar,
If the company is deciding I want to do periodic buybacks, so and it has a question that should I do periodic buyback or not? It may send a negative signal in the market. So these are some precedents. There are companies like Bajaj Auto, Filatex, Bharat Rasayan, Indian Toner, which has done since their listing, they have done buyback only once, and till now they have not come up with any buyback plans. There are companies who have been doing frequent buybacks, maybe yearly buybacks, like Balrampur Chini Mills, Wipro, Aarti Drug, TCS, Infosys. And there are companies who just got listed a year back, and they're now doing a buyback.
Tushar, 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 can you hear me? Tushar, I think we can skip some of the two nitty-gritty wala details.
Sure.
We should, the important points are needed to be taken up. Actually, RK sir has to leave thereafter.
Action will
Yeah.
be discussed by RK sir. I think Tushar, you can leave this slide.
Sure. Next slide.
Next.
Yep. So again, deciding the factor, there are 3 methods of returning value to the shareholder. One is buyback, dividend, and bonus, and we discussed the factors regarding these. Next slide, please. So impact on the reserves. In the bonus, the reserves get capitalized. In the dividend, and buyback, we give off the reserves. The company does not keep the reserves, but in the bonus they are there. The capital increases in the bonus. In dividend, there is no change in the capital, and in buyback, the capital decreases. If we talk about the cash outflow, bonus may there is no cash outflow, but in dividend and buyback there is cash outflow. In tax, for the taxation perspective, in the bonus there is LTCGs, STCG as per the applicable slabs, it's over there. In the dividend, as per the individual slabs, it's effective. In the buyback, it is 23.3%, to be discussed in detail further. What about the non-traceable shareholders? Mostly all the companies have some shareholders which are non-traceable for years. So in the case of bonus, these shares will eventually go into abeyance and go into IEPF. And if the company declares dividend and there is no one to claim those dividend amount, these amount also go into IEPF. But in the case of buyback, if no one come up to participate in the buyback, nothing happens. That amount declared, if the partly pending, it will come back to the company. Regarding the price adjustment, bonus and dividend have impact on the market price according to the ratio and the dividend amount rupees. But in the case of buyback, there is no adjustment in the market price. Next slide, please. So buyback as a method to return value. If you think from the perspective of buyback, it has its own benefits as well as hurdles. Dividend virtually serves no other benefit, while buybacks are more tax efficient, supports trading volume, improves return ratios, and help consolidation of capital and shareholders base of company. But procedurally, dividend is smoother as it involves no regulatory approvals, multiple document filings, appointment of intermediaries, advertisements, etc. One more benefit is this: the buyback draws more media attention as compared to dividend. Next slide, please. Buyback as a method to return value. Again, although the calculation of the change in EPS is of interest of company, it is not an indicator of value creation. It is just because of reduction in capital and the PAT remains same. The EPS increase is a mechanical increase. So what should be the other decisive factor that a company is decreasing its capital? So whether the price at which the shares are repurchased is less than the estimated value, there should be undervalued stock buying. Whether the cash utilized towards the buyback will translate into better performance as compared to where they were invested, whether the marginal rate of return on the funds returned to the shareholders is less than the cost of capital. Next slide, please. So is buyback biased in category of shareholders? First of all, there is no category like promoter or public in case of buyback. There are just shareholders, and to make a category, there is a category in the SEBI regulations, which is small shareholder category. No other category. And for small shareholders, they have a reserve. The SEBI makes a reservation of 15%. So we can not say that it's a biased towards any kind of any category of shareholders. Next. Some myths around buyback are: does buyback reflect the company has no use of surplus funds? No, not at all, because there has been cases more than 50 to 30% had been doing capex post doing their buybacks. Next slide, please. Buyback is done only to increase promoter holding? No, not at all. There are many cases the promoters were also participating in the buyback, and it was not done with the purpose to increase their promoter holding. Next slide, please. Yeah. Now we can start with the taxation slides. I hope so.
Thank you, Tushar.
Thank you all.
Now, thanks for the insightful presentation. I think you have covered a lot of things. Now I'll ask RK sir to share his views on how the taxation impact of buyback will work, and whether he feels that in future there will be parity between both dividend and buyback. So I'll leave the platform now to RK sir.
Thank you, Ankit. Yes. Good evening, everybody. So far as the taxation aspects of buyback of shares are concerned, there is the section 115 QA in the Income Tax Act, which determines or which states regarding the applicability of tax in the case of buyback of shares. And according to this, there is a fixed rate of 20%. And as per the budget memorandum, budget rates where are announced every year, union budget, the surcharge on buyback of shares has been fixed at 12%, irrespective of the slab of surcharge in which a company is falling. A company may fall in a regime where there is no surcharge, or 10% surcharge, or 15% surcharge, but here 12% surcharge is fixed on in case of all buybacks, plus 4% is cess. So effectively the rate of tax is almost fixed for every kind of company, either listed or non-listed, or private limited or public limited, or whatever the income slabs, which comes around 23.3%. And in the case of shareholders, there is no tax attracted at all. That is very clear, because under section 1034A, exemption has been given that in case of buyback of shares, it is the liability of the company to pay the taxes. Shareholders are not required to pay any tax. So it becomes a another attraction while planning or just discussing various pros and cons, whether buyback of shares should be done, that if there is no tax liability, personal tax liability, which is fastened in the case of the shareholders. And the takes the tax rate, as I said earlier also, is applicable same tax rate to all the companies, whether listed or unlisted, private limited or public limited. In the question answer, somebody has asked what is the applicability on private limited companies. So irrespective of the nature of the company, the tax rates in the case of buyback are the same. And tax is to be paid by the company over and above the buyback price which is being offered to the shareholders. And I mean, no TDS, of course, is required to be deducted because it is not a tax for which any credit can be taken by the shareholder. Rather, it is an expense to the company. Neither company can take any credit of this, and it will be charged to profit and loss account. Tax is required to be paid within 14 days from the date of payment of any consideration to shareholder on buyback of shares. So immediately tax is required to be paid. It is not that you can wait till filing of the return or after the closing of the year. Rather, whenever the payment is made to the shareholders, within 14 days of that, payment of tax is required to be made. Yes, next slide, please. Now, the most important question comes that what is the amount of buyback to be taxable in the hands of the company and how it is to be determined.
Sir, before you move on the slide, there was also a question that while tax is not payable at the hand of shareholder, whether there is any capital gain tax that he needs to pay?
No, not at all. Shareholder is not required. Ankit, shareholder is not required to pay any taxes, irrespective of the cost of acquisition of the shares in the hands of the shareholder. Because, for example, a company is buying back the shares at, say, 1,000 rupees per share. And shareholder might have purchased those shares, some shareholders at rupees 10 initially, or some might have purchased from the market at rupees 400, or some might have purchased at 800, or some might have purchased as a got as a bonus shares. So irrespective of the cost of acquisition of the shareholder, no tax is required to be paid in the hands of the shareholder. So it means that in the hands of the shareholders, whatever the consideration is being received from the company towards buyback of the shares, it is a capital receipt. It is not going to be taxed either under the capital gains tax or any income in the income computation of the shareholder.
Thank you.
Yes. Now the question comes regarding the taxable amount. And taxable amount of buyback in the hands of the company is the value of buyback value of shares reduced by the amount received by the company. So now there are two elements, that what can be the buyback value of shares by the company, and second is what is the amount received by the company on issue of such shares. So we have to determine these two things. First of all, the buyback value of shares. So far as the buyback value of shares is concerned, there is no concept of fair market value to be determined for the purpose of buyback of the shares. It means that the management has got the discretion to buy back the shares either at premium, whatever premium they decide themselves, or maybe at discount, whatever discount they decide as per the strategy of the management or as per the objective of the management. So section 50 CA, section 50C, the 56.2, that those sections are not applicable in the case of buyback of shares. 56.210 is not applicable because there is no transfer of the shares. Company is not getting any property as a transfer of the shares. The shares are going to be destroyed, to be received back by the company. And so far as the value to be determined under any rules, etc., that has not been prescribed. So in question answer, there is a question that whether merchant banker valuation is required for the purpose of buyback, at what price the buyback can be done. Answer is no, because it is the discretion of the management at what price they want to buy back. And discretion or determination of the price on which shares are to be bought back can be determined in view of the objective. As we have discussed, Anjali and Tushar, they all have discussed, there can be so many objectives due to which buyback is done by the management. maybe restructuring, maybe one promoter going, maybe reducing the capital, maybe cash surplus to be given back, maybe that compensation to the shareholders if market price is less. There can be different objectives. So depending upon the objective of the management, they can determine the price. If they want to compensate more to the shareholders, they can come out with buyback with the premium, higher premium, even 80-90% of the premium. Or if they want that restructuring is to be done without any tax liability in the hands of the company, then they can come with a lesser price, and I mean with a lesser value, less than the net asset value or fair market value of the share, and at that buyback is possible. Buyback can be done. So companies are using this instrument for planning, for meeting out different objective, depending upon in what manner or for what purpose they want to do buyback. And then there is Rule 40BB under the Income Tax Act, which is also to be looked into from the point of, for the purpose that what is the amount received by company on issue of shares is to be determined. So the second element is that we have to determine what is the amount received by the company on issue of share. So the rule is that whatever the amount company has received, that can be linked with the particular distinctive numbers of shares which are being bought back. So these shares may be of different value which have been issued by the company. Initially maybe at par 10 rupees. Later on maybe at some premium. Premium can be of any magnitude, or there can be bonus shares which can be issued, which have been issued at nil value. So the thumb rule is that whatever the amount, including premium, which has been received by the company on those particular shares, we have to link it with the shares which are being bought back. So I mean, irrespective ki shareholder ko kis price mein mila hai, usse koi matlab nahi hai. We have nothing to do with that, because shareholders, they may keep on changing the hands at different values. Whatever the amount which has been received by the company, so there can be Rule 40BB if we go into, and if we read, then there are so many situations which they have envisaged. Maybe in the case of amalgamation, maybe in the case of demerger, maybe in the case of bonus, different situations may be there. But the thumb rule is that either to a company which is doing buyback, or to the previous company, amalgamating company, or if it is a demerged company, then the company which was existing earlier, from where the resulting company has emerged. So the original company, which whatever the amount has been received by that company, paid up capital plus premium, that is the price which will be required to be reduced from the value which has been decided for buyback. So if a company is buying back at 1,000 rupees per share, and the amount received by the company on different shares, on some share it may be 100 rupees, on some it may be 200 rupees, on some it may be nil value, then tax liability would be different on different shares. So company has to look into that the total price value which is paid, and the cost and the price which has been received, amount which has been received by the company on shares, which will be different in case of each class of shares, or each kind of shares, or each distinctive number of shares. That amount is to be reduced, and on the difference, this tax is required to be paid. Yes, Ankit. Ankit, please.
Sir, what if a shareholder has been issued shares both at premium and at par, and now they are in demat, and companies buying back certain portion of the shares? So how to determine, for example, that he has 1,000 shares, 300 is from par value, 700 is at face premium, and they are buying back around 100 shares. So how to determine which portion, because they are in demat, they don't have any number, they are fungus. So how to determine the amount of premium?
So sub rule 12 of 40BB states that in case in such a situation, when you have to apply FIFO method, that in a particular folder of the shareholder, there are shares of different nature. Then first shares which have been credited to demat account, those shall be considered for the purpose of buyback at this point of time. So FIFO method is to be applied for that purpose. But so far as the different shareholders are concerned, their distinctive numbers or the nature of shares would be clear. So accordingly, the price which company has received, that can be determined by the company linked with the distinctive numbers of the shares.
Basis date of allotment, we need to consider which one will be out first.
Yes, because each share, whether it is in demat or physical, has distinctive numbers. I mean, the shares which are now being determined as per FIFO method, those shares will be looked into that what is the price company has received on those shares, and that cost will be reduced from the buyback value, and on the difference, tax is required to be paid.
Okay.
As Anjali has sent me some posers, and all those posers are addressed in Rule 40BB. Because these are that what would happen in the case of amalgamation, in the case of demerger, in the case of bonus share, in the case of the point which Ankit has just asked. So all those have been given in Rule 40BB, and the answer and thumb rule is that the cost, the price which company has received, or if there has been any amount paid by the company on those particular shares, it will also be reduced. But if company has not paid any amount for any other reason, then the price which company has received, that is required to be reduced from the shares which are being bought back. Next, please. In any case, if nothing can be determined, there may be situation, then residuary in 40BB rule they have said, then par value will be reduced. Only paid up value will be reduced. Yes. Then a question comes which has been addressed earlier also, whether fair market value is relevant for the purpose of buyback of shares. I have already addressed this question. Answer is no, because buyback of shares is not required to be done at fair market value, or at market value to be determined and as per Rule 11U or 11UA in the case of transferred shares, or taking a certificate from the merchant banker. It is not needed, or nor section 56(2)(10) can be applicable in the case of buyback of shares. Next, please. Yes, we have already discussed that in the hands of shareholders, there is no taxability at all. It is to be treated as a capital receipt for them, irrespective of the cost of acquisition by the shareholders. So no capital gains tax, no income of any nature to the shareholders. So it becomes a big attraction when the decision of buyback is taken, where there are certain vested interests involved in that. Yes, please. As we have discussed that there can be different objectives for the purpose of buying up back of the shares, and depending upon the objective, one may decide whether to do buyback and at what price to do buyback of the shares. So one question comes, dividend versus buyback. In the case of dividend, it depends because it is taxable in the hands of the shareholders, and in the hands of the shareholders, there can be different slab in which shareholders falling. If it is individual, the slab rate may be starting from 5%, it can go up to 39%. In what income bracket you are falling, depending upon that. Highest slab is now 39%. Is 39%. So if shareholders are falling in the highest bracket, for example, HNIs or promoters themselves are interested in buying back of their own shares in some other form, then if we compare 39% to be paid by the shareholder and 23% to be paid by the company, which is a better proposition. Depending upon the pros and cons, one can take a decision. So I mean, I will not say buyback is always a substitute of dividend. There can be different objectives of paying the dividend. That is entirely a different thing. But sometimes when a chunk of the amount is to be taken or to be distributed to the shareholders, other than the routine income or routine return on investment in shares to be given to the shareholders, then the instrument of buyback is applied or it is resorted to. So since section 56(2)(10) is not applicable, then of course the buyback price can be determined neither by the company as per the objective which is there for which buyback is being done. There are certain companies where the objective was, particularly private limited company, the objective was to restructure the shareholding. And the issue was not that the amount is to be given to the shareholders in their personal hands. So only for the purpose of restructuring, they did it without any tax liability. They could do buyback at a price at which the shares were issued along with the premium. Yes, so I think these are certain tax provisions. If there are any queries, you can just address me right now, because after this I will be leaving as I have to attend another webinar. Yes, Ankit, if in chat box, whatever the queries were there, I have gone through most of them up to 32, 33, but still if it is there.
I don't think so. I think almost all the things there were which are in the chat box have you have already covered in your presentation.
Yes.
There is a small question by Mr. Dushyant.
Yes.
Tax impact is less than dividend. I believe you already informed, shared that.
Yes, because it will depend that the shareholder is falling in which bracket. Highest rate can be 39% if it is an individual shareholder. If it may be corporate shareholder, it may be firm of LLP shareholder. So depending upon the nature of shareholder or the slab in which it is falling, it may be ranging from 5%, it can go up to 39%. And versus in the case of company, it is fixed. So if first of all, company is paying, shareholder is not paying any tax. And then shareholder may pay higher tax. So depending upon that, whatever the objective of the buyback is there, one will have to take a decision. But nevertheless, buyback can never be the substitute, or can not always be the substitute of dividend.
There is a question by Mr. Mukul where he says that if there is an NRI shareholder, whether any TDS to be deducted in that case?
No, there is no question of TDS, because tax is to be paid by the company, not by the shareholder. Shareholder cannot get the credit of any tax which has been paid by the company. So there is no question of deduction of TDS.
I think, sir, almost all the things you have already covered in the presentation.
Okay, thank you. Thank you, everybody. Thank you very much.
It was a pleasure to hear you again.
Thank you, sir.
So we have now Manoj with us. Manoj, if you can share your view, how you think buyback can be used as a strategic tool, while both Anjali ma'am and RK sir have shared their views. You can also, if you can add some additional points.
Yeah, good afternoon, everyone. So I think most of the things are already discussed. Taxation part is one of the most important aspect while planning for a buyback. So that has been very well covered by Dr. Rajkumar Agarwal sir. And Tushar has also talked about the strategic decisions. Anjali ma'am has already discussed the initial point, and for listed company, what are the basic planning. So obviously the objective in case of listed company remains the similar, like one, to give return to shareholders, which may have positive impact on the share price of the share in the market. Sometimes where there is high volatility in the market of companies' shares, then issuance of buyback at a certain price would stabilize the price, and it obviously gives return to the shareholders at a tax efficient manner. So shareholders are generally happy about the buyback. So that is one of the most important criteria for deciding this. Then it is always, we have seen that in case listed companies having cash surplus, which is not getting invested immediately for any project or any business, then it is always a pressure from the shareholders' point that why this money is lying in the books, which is not getting value in the market. Generally, market value of the shares based on the price earning multiples or earnings which are happening every year. So in case there are cash which is only giving maybe certain return in the form of interest from FD or something, market does not like that type of return on the market. So because we know that the cost of equity is much higher than cost of debt or any return which is 6 to 8%. Nobody expects 6 to 8% return from investing in the capital market. So it is always advisable to go for a buyback and buy out certain shares, which will return the money to the shareholder. Surplus cash is utilized and balance sheet becomes healthier. Whatever assets are there, all are deployed for the business development purposes. So surplus cash is gone from the balance sheet to a certain extent, and which is received by the shareholder at a lower tax rate. So that is one of the most important criteria for a listed company. Obviously, we have to see all companies are not good or not fit for going for the buyback. So if it is already highly leveraged company, like company has a debt equity ratio much higher, then it is not advisable to even consider the buyback as a tool to give return to the shareholders. Obviously, bankers would not object to a regular dividend return, which is going in on annual basis. But if they go for buyback, it is a capital kind of transaction. So bankers would also take it very negatively, and this can be a negative for the company to go for such kind of transaction. So yes, we have to see the health of the balance sheet, see that there is no deployable use of the cash immediate or near future, then only go for the buyback planning. All other plannings have already discussed. But I would like to discuss some of the very important aspect in case of unlisted companies. So why unlisted companies go for buyback? As RK sir was telling, and obviously we have already discussed that tax is one of the very important reason. If the company is earning good revenue, good profit every year, and the promoter want to take out the money, the dividend is very costly affair, because as RK sir was telling, it can go taxability can go up to 39% in the hands of the promoters, who are the major shareholders, if their earning is 5 crore or more. So in such cases, buyback is much tax efficient. The cost goes into the company's book, and it will be tax free in the hands of the promoters. So they will prefer to have this. But we have to, like RK sir was telling, there can be different plannings. Like there are one set of shareholders who want to take exit from the company, and general way is to buy those shares by the remaining shareholders. But instead of buying at their own pocket cost or cash outflow, that can be shifted to the obligation of the company. Company can bring at a buyback issue, and the shareholders can tender their share in the buyback and exit from the company, taking the money in a cash neutral manner. So promoters' object of giving exit is also fulfilled, and buyers, sellers are also get tax-free income. Otherwise, it will be a capital gain situation in the hand of the seller shareholders. So that can be one of the scenarios. Similarly, there can be scenario where internal percentage shareholding need to be reclassified, regrouped. For that, certain shareholders may tender higher number of shares, others may put lesser number or no share in the buyback issue, and in that manner percentage shareholding can be balanced. In such case, buyback price can be lower or near to the book value of the company. So in that case, there is no tax in the hands of the company also. So at zero cost at the from the books of the company, zero tax cost in the books of the company, shareholding structure can be verified. So such kind of plannings are very well prevalent, and wherever there are private equity funds and the company is not in a position to go for IPO in a limited determined timeline, they prefer to go for buyback issues in such cases. So these are the plannings, and I think we have well covered many of the things. So let's move towards the question answers and try to address as many questions we can address. Thank you.
Thanks, Manoj, for your view. So I'll start with you. Received a lot of questions both before the webinar and during the course of the webinar. So I'll start with the first one. So Ms. Neha Goel.
Ankit, can you be a bit louder?
Okay, I will try my best. So Ms. Neha Goel has asked a question: how to calculate value of buyback shares? So any of you can
see? As I said in the PPT as well, the buyback is freely priceable. It ranges from even 10% to even 90%. It depends upon management to management, how much they want to return the value and what asset do they want to liquidate for the purpose of coming out with the buyback. It depends from management to management.
The regulator has raised question on the buyback price?
No.
And I think in case of unlisted companies also similarly, you are free to price it.
Yes, it can be at discount or premium, anything it can be.
Anything.
Then Mr. Unmed Mal Jain has asked, stamp duty payable on buyback of shares. I don't think there is any stamp duty that is payable on buyback of shares.
No.
No, it is a cancellation of share. There is no duty.
And Ms. Neha Goel again, if public will tender shares in buyback, then what will be the status of holding of promoter?
It will go up. If promoters do not participate, the percentage will go up.
Okay. Then Mr. Vikas Parikh has asked whether selective buyback is permissible.
No.
No.
In fact, in the buyback regulations, Manoj, you may add if you want to, but it is clearly negated that negotiated deals are not permissible.
No, it is not about the negotiated deal, but practically, if someone is not tendering in the tender offer or buyback, nobody questions it, and it is just commercial decision of the individual. So, like I discussed, in case of closely held company, there is a private equity fund which need an exit. And structured, it is a buyback is structured where offer is given to all, but the promoter does not tender any share, and all the private equity funds tender. That's totally valid. So it is a selective buyback, but obviously offer is given to all.
Yeah, I think that's a way to do it. I think this question asked by Mr. Pankaj.
Company cannot discriminate between the shareholders, but shareholder can decide their own fate.
That's all. So, Mr. Pankaj, I believe your question is also answered. So Suresh has asked whether permission of RBI is required for buyback in case of NBFC.
There is no requirement of prior approval of RBI.
So Mr. Vineet Kumar has asked, can we go for buyback one after the another? Yes, I think there is no. Apart from
it can be year after year.
Yeah,
but in 1 year, we can come out with buyback only once.
Okay. In Mr. Darshan has asked, in case of open market buyback, how it will support falling share price?
So I think Tushar has well said, and ma'am has also discussed. If it is a open market, we have a kitty of fund to be bought and upper price at which it can be bought. So based on the supply, the market price falls when there is a supply, higher supply than demand. So demand can be created by the company from this kitty, and hence all the demand supplies are absorbed. So price would not fall.
Okay. So Charu, this is for you. Ms. Divya Chuk has asked, how to buy back shares from the shareholder that are not traceable, and what will be the treatment of such shares?
So in case of non-traceable shareholders, so basically those would be in the private companies only, I guess. But traceability, if they are not traceable, how can we say that we can buy back the shares from them?
Offer is made to all the shareholders, whether traceable or non-traceable. But somebody who is not traceable obviously will not be in a position to tender the shares.
And it will apply both, even in case of a private company or a
yes, both.
In fact, in case of listed company, there are hundreds of thousands of such shareholders who might not be having the email ID, not given the email ID, or not getting the annual return. So they will not be getting the notice also. But notice is published in the newspaper also, and stock exchanges also. If they want to proceed, they can get their shares rectified, dematted, and then tender in the offer.
Rather, Manoj, in case of tender offers, SEBI specifically directs us that we have to take special efforts to reach out to the physical shareholders and non-traceable shareholders so that they are in a position to participate in the offer.
Yes.
Akshay Kumar has asked a question whether a company can convert their CCPS into equity and then do the buyback of these converted shares from the proceeds of CCPS.
So if the object of the CCPS was to do the buyback, then it is permissible. Otherwise, if
CCPS to do the buyback.
So otherwise, no.
No, it is. I think the question is that if you are increasing the paid-up capital by converting paid-up equity, and then you are buying those equity, is it permissible? That is the question, I think.
Restriction as such.
It's not clear. I don't know.
Okay. Mr. Mukul has asked for rules on private company regarding buyback of shares. I think, Mr. Mukul, they are detailed rules. I don't think this
Company security shares.
Mhm.
our procedure book to get much clear detail on as to how to buy back shares of a company. Then Mr. Nishchal Mittal has asked, is there a ceiling of max 25% or number of equity shares that can be bought back in one tranche?
The ceiling is for the financial year, not for the tranche. It is for the financial year.
I think there is some confusion in this respect. The law says that the amount which can be utilized should not be more than 25% of the paid up capital and the free reserve available with the company. And what quantum of shares can be bought back is not clearly written in the act or law. Earlier, it was clearly mentioned that not more than 25% of the paid up capital can be bought by the company in one financial year. So,
Sir,
but
in the recent amendment, they have again clarified
covered-
the explanation.
They have covered it.
in case of SEBI listed company, but not in the companies.
Not in,
In numbers also.
yes.
In unlisted companies, as Manoj said, these positions
Yes.
there continues to be this confusion. Okay. Then Aishwarya Madan has asked how to extinguish the share certificates practically.
So, in case of share certificates, the physical share certificates are destroyed by the RTA, which they receive, and then the shares are the number of shares which are accepted, and this split the share certificates are split, and the remaining for the remaining shares, the new certificates are printed, and for the old ones, they are just torn out and extinguished. And
But
the new
for example, in case of listed entity, does this happen in presence of any company official or the merchant banker, or it is leaves to the discretion of the RTA?
Sir, it generally happens in front of the company.
I think rules has a specific provision relating to how to destroy and deface and destroy those shares. So it has to be in the presence of, I think, official and who will make entry in the register of buyback and then destroy the
Yes.
physical shares. So within 7 days from the date of receipt of the share.
In case of a buyback up to 10%, whether we need to have a mandatory provision in the articles?
Articles.
Any articles there has to be a provision in the articles for any buyback.
This was asked by Ms. Meeta Thakkar. Okay, so Prashant Khatri has asked, what is the reason of eradication of buyback from open market?
So I think as I mentioned, that the companies used to declare a price, but they used to buy back at much lower price at the running market price. So it was virtually a eyewash, and that is why SEBI wants book build methods to be encouraged, wherein a band would be there, and the public will have an option to tender at any range in between that band.
So it is more like there has been a cases, or there has been a thought that buyback from the open market is used as a tool to manipulate the market price or manipulate the volume of company share, because threshold is kept at a higher rate, and then obviously price is pulled towards that through need-based selective purchase. So sometimes even zero purchases were made or very little share were purchased and the price got up. So that kind of manipulative practices have been found by SEBI, and hence they want to curtail this.
Okay. Mr. Prince Parashar has asked, can a company withdraw buyback offer once made public?
Once PA is given, after that it cannot be withdrawn, but before that it can be.
Okay, so once if I just give an intimation and then before the PA I want to withdraw it, it can be done.
It can be withdrawn. We have seen that in past cases.
Okay. Okay, Mr. Rajiv Sir has raised a query. He has raised a request to upload the video recordings of earlier webinars. We'll try to do that. I'll ask my team to quickly work on that. Mr. Shiv Kumar asked, can a member buy back those shares which are not accepted by a member in case of a private company wherein the overall shares offered for buyback doesn't not change? I believe he's talking about a member buyback. I believe there is a situation where you offer additional shares. Are offered, he doesn't offer his shares back to the company. But in case any other member who has been offered and he has been given an option to give an additional offer, I think in that case only it is possible. Otherwise, if it has been offered to a person, he doesn't buy back, doesn't accept the offer, then the other person don't have any right unless and until he has been given an option to give an additional share. Valuation, Mr. Vikas has asked, valuation report required to be obtained from registered valuer or merchant banker. So as we
In
discussed,
case,
requirement of any.
in case of book built issues,
Yeah.
valuation is required from registered valuer, not merchant banker.
Okay, but have we discussed there is no need of valuation, Tushar?
But
Otherwise, no, otherwise there is
Otherwise,
no need
Otherwise,
for that.
In case
but
of
to decide a base value, this is a new amendment.
I think
Previously, there was no
Charu
requirement.
or Tushar, your voice is vibrating. One of you have to mute first.
Tushar, you meant to say that in case of a buyback through book building, we need to obtain the valuation report from a registered valuer.
For a base value.
Okay.
In case of infrequently traded shares. For a
Infrequently
frequently traded share, not required.
Otherwise, it is not required in case of unlisted companies. Yes, but in case of unlisted companies, it is only required in case there is a buyback from a foreign resident, because then the FEMA provisions will trigger that is applicable to transfer of shares. So you have to consider the buyback accordingly, considering you require report from either the merchant banker or a CA. Okay. Mr. Amit Chaurasia has asked, in case of a listed company, after a buyback, or a company cannot raise capital for 1 year from closure of buyback period. Does capital include CCPS or CCDs or both?
Yeah. You're restricted from issuing any specified security, and CCPS and CCDs are included there.
Even I cannot issue a convertible security.
No.
That will take place after the year.
After the year.
That is not possible. That is not allowed.
No.
That is, the law is very much clear that if you are buying back, you are reducing the paid up capital. Then once you are reducing, why again immediately increasing it back to the same level?
Then another question from Mr. Amit Chaurasia. In case of a listed company, in case of a tender offer, can I only accept shares offered by the promoters and ignore public shareholders? I want to
Not at all.
No.
Not at all.
As we discussed, there is no selective buyback in case of a listed entity. Okay, Mr. Kansha Gupta has asked, can managing director holding shares in the company participate in the buyback offer provided he is related to the promoter, as promoter is restricted to participate in buyback through open market as per SEBI buyback regulations?
So under the open market, promoter and promoter group is restricted. So obviously, if the MD is related to the promoter, he'll fall within the ambit of promoter group. So he'll not be in a position. He'll not be in a position to tender. Yeah.
If he follows the definition of the immediate relative.
Yeah.
I did, yeah. Okay, can we get a copy of? You will get a copy of all the presentations in all the webinars that we do. Whether benefit and Kapil Sangvi, I believe Manoj, this can be answered by you. Mr. Kapil has raised a question. Whether benefit of lower tax rate in capital gain article of DTA can be claimed for buyback tax?
No, as RK sir has clearly mentioned, it is a liability of the company, and company is obviously Indian citizen, Indian resident for the tax purposes. So it has to pay the tax, and there is no set off or tax is not deducted, no withholding taxes they are applicable to the shareholder who is non-resident. So no benefit of DTA can be claimed by the person.
And there is another question that in regulation 17 subclause Roman 2 of buyback regulations, a record date has to be announced, whereas in the presentation which we made today, it is mentioned that no record date is required.
Ankita, there is a request. You will have to be louder.
I am trying my
best. One of the participants has messaged me.
I don't know why I'm not audible.
I probably.
So I'll try my best again. So in our presentation, have we mentioned that no record date is required in case of a stock exchange process of buyback?
Yeah. Because open market is open for a period of 6 months. Anybody, even if I buy the shares today, I can tender it tomorrow in the market. So there is no significance or no need of a record date in case of open market. Okay. Tender route, yes, of course, a record date is needed.
Okay. Valuation we've already discussed. This is again. And then Vidya Pawar, if there are different types of equity, like normal equity with differential voting rights, whether buyback offer shall be given to all types of the equity shareholders?
I think it is to a specified class of equity.
Board has to decide for each
Ah.
class of shareholder what they want to do. Each class is different. In case of listed company, obviously, if we have listed 2 class of shares, we should generally give offer to all. But otherwise, privately held company, it can be for differential voting right. Different persons, different treatment can be given.
Another question: in case of a listed entity, the buyback amount, the 25%, whether it includes the buyback expenses?
No, no. It's clearly mentioned, excluding transaction costs, brokerage, all those things.
All these things, sir. Okay.
Tax is also over and above.
Tax is also over and above.
Okay. The valuation is required in case of buyback in private company. Mr. Arun, we have already informed that buyback valuation is not required. Only in case of mandatory where you are buying back from a foreign shareholder. Otherwise, it depends upon you. If you are giving it want to give it a fair value, then you need to get itself valued, and all the valuation under the company that are done by a registered valuer. So Amit Chokasi again, can you throw some light on trading window concept in case of buyback?
So, as per the guidance note issued by SEBI, since a buyback or a rights issue or offer for sale is being given to all the shareholders, so trading window concept is not applicable in such cases. So the designated persons can tender even if the trading window is closed.
But we have to be careful. It is the planning is going on, then those who are involved in the planning should be considered to be restricted from trading in the market, because it is a price sensitive information. So if it is in public domain and tender time is coming, they can tender it.
Okay. Selective buyback, we've already replied. Manoj, what's the usage of the reserve that we create after buyback?
So it is a capital kind of reserve, and obviously it can be used for issuance of bonus shares. Other than that, it can't be used for any other purposes.
Okay, so Satya, calculate value we already shared. Mr. Umaid, who has asked about stamp duty earlier, he has again mentioned this point that NSDL asks for stamp duty on buyback of shares through tender offer. No,
Taru, have we received any such query from NSDL?
No, ma'am. Never.
Okay, I think we'll check back again with NSDL and see why they're asking for the stamp duty, and we'll come back to you, Mr. Umaid Jain. Is it, Mr. Kushal has asked, is it possible to force all these shareholders to buy back in their existing proportion? I don't think it's an offer, so it's up to the shareholders whether to accept that or not. Okay, and another person has also mentioned the same point that stamp duty was asked. So Charu, we better get it checking.
We'll check it.
Okay. So Mr. Ever asked whether it is mandatory to comply with the minimum public shareholding requirement?
So,
to achieve MPS?
in case post buyback, the MPS is breached. The promoter is at 70 and by virtue of buyback, 76 पहुंच गया. So within a period of 12 months, he'll have to bring it down to 75 by following any of the modes which have been allowed by SEBI.
But can also be used to meet the requirement of MPS if I bet for
buyback. No.
Cannot do it. Okay. Okay. So Mr. Anup has asked, in open market purchase, 25% of the daily average turnover of shares for last 10 trading days is the set limit for a bid on a particular day. So whether the volume of buyback done is to be included for computing average to be included or excluded.
So see, this point has been amended only recently, and even we are trying to assess as to the implication thereof. But what we understand, of course, with the buyback that has been done on a particular day will be included while computing the VWAP.
In case of open market, we cannot differentiate between the buying by the company or buying by third party. It will be combined volume.
Okay, Manoj, Mr. Kapil has asked, can FTC of buyback tax can be claimed by NRI in country of residence?
No, as it is a cost of the company, nobody can claim any expense or benefit out of that.
Okay.
Even companies are not allowed to take advantage of buyback tax as expense in their books.
Mr. Manoj Jain has asked, can IPF authority tender shares in buyback?
IPF authority, I don't believe they are just a custodian. They cannot participate or take a decision on those shares.
I am trying to be louder, Ms. Vidya. So, Ms. Prachi has asked, in case of private company, can we buy back the shares of a foreign national on face value of shares, even if we issued the shares to other shareholders on premium value within 2 months?
Yes, because as per the FEMA law, higher there is a restriction on purchase at a price higher than the fair value. So lower than the fair value is allowed, so you can buy.
Okay. Is buyback tax payable in case of open market buyback?
Yes.
Yes,
Yes, sir. It's payable.
What is buyback tax? By the company.
Yes, by
By
the
the
company.
company.
By
Yeah.
the company only, and the investor who has tendered shares in the buyback will get a message for the portion he sold in the market and got selected in the buyback, and so that he can claim his exemption. And on the part which got sold in the normal market, he has to pay LTC GST accordingly.
Yes.
There is an interesting question. I think this is always a point of confusion. Mr. Hemant has asked, what does completion of buyback means? Is the date of the payment of consideration or the date of extinguishment of the share certificates?
I think it is
Payment of
payment.
consideration.
Payment. We believe we all follow payment.
I think even in
Ma'am, it's written in the regulations
It's
itself.
virtually written. Yeah.
even in the rules under the Companies Act, it says 7 from the completion of the 7 days. And if you read the rule in the context, it will mean definitely the date you make the payment.
Right.
Okay. Most of the questions are of valuation. Mr. Anup has again mentioned that in case of market buyback, record date is required to be announced to determine the date of the opening of buyback. Please refer Regulation 17 subclause Roman II.
It has been added, and we are still trying to understand what is the purpose of mentioning a record date in case of open market buyback, because there is no eligibility criteria like in tender offer and in any other corporate action.
I agree. I don't think because
So, but the timelines are moving according to the record date. Like within 2 working days of record date, you have to do this event and this event. So we still need to understand this purpose. It is mentioned over there.
Record date in true sense, while they are taking it as a record date, because it's not the, as you mentioned, during the entire period of the buyback, anyone can buy and sell the share or tender the share. There is no one date on which you recognize the
Yes,
shares
sir.
are eligible to buy. Okay. Time gap between 2 buybacks, I think 12 months is the time gap.
Once a year. Yeah.
So Anil Shah has asked, can the company offer different purchase for different voting right shares issued by a company? I believe
Yes.
but they have to offer a separate buyback offer.
Yes, there will be separate buyback
They will be
offers.
separate.
It is generally for closely held companies. Yes, if they are different series of equities and having different rights, then different buybacks would come, and for that prices can also be different.
Ms. Sandhya has asked whether standalone consolidated financials are required for buyback limit for unlisted companies. I believe for listed,
Whichever is stricter.
Consolidated, but under the Companies Act still continues to be standalone. There is
Standalone, yes.
consolidated financials for under the Companies Act. Okay. Can ESOP, Mr. Mandeep has asked, ESOP Trust tender shares in buyback? I don't think ESOP Trust tender shares. Okay. Emriel Pereira has asked, if company has done conversion of CCP to CCD into equity, can it do buyback after conversion? Does the company need to wait for certain timeline or period before they opt for buyback? I don't think there is any such timeline.
No timeline is there.
Okay. BSC and NSC on their website, Mr. Anup has asked, BSC and NSC on their website provide separate data of volume of normal market data price and that of buyback on a particular day. Is this appears to be a question to you?
Maybe they are trying to relate it with the pricing. Pricing we need to connect with the volume thing.
Okay.
In the case of open market buybacks
As per
and
regulation,
BSE.
Ms. Pooja is
I think this is comment relating to what we had discussed, that there is no separate differentiation for VWAP purchased by company and purchased by others. So he is saying that we can get the differential data. Differential data is available on BSE and SE.
Thank you. So Ms. Pooja has asked, as per regulation 5 subclause C of buyback regulation, it is necessary for the company to apply for lender NOC even if there is no breach of any covenant. And if yes, at what stage do the companies required to apply for NOC, as the buyback of shares will be UPSI unless becomes publicer?
Any NOC should be before board meeting.
See, the way the companies interact with the merchant bankers, because it is still a UPSI, they sign a NDA with us. Maybe on the same basis, they will have to apply to the lenders as well for their NOCs before the PA.
So this is applicable even in case of WC limits?
Even in case of
working capital limits.
Working capital limits. Working capital limits is not lenders actually.
No, they are lenders, and yes, whether it is financial creditor, it is a financial creditor, whether it is for a long-term purpose or short-term purpose. Yes, if there are debts in the books, we have to seek no objection.
Sir, Vinod has asked, if company issues check against buyback of shares, what date will be considered as completion of buyback?
Payment, I think we have discussed this.
The payment, the mode of payment is check. So check clearance should be our just issuance of check. That is the question, I think. So I think reasonably, so company should issue the dividend.
Now it's not check. Now it's automatic. No, through the
bank account. You are talking, ma'am.
Bank account connected with the.
There may be closely held companies also.
Then it's a different right.
Ms. Jinal Sangvi, how will company came to know their tax liability? I think they have to apply the formula that's given under 40BB.
Yes.
I'll want to explain this. As R.K. Agarwal sir also said that the company has to follow the FIFO method, meaning thereby if the company is doing a buyback of 10 lakh equity shares and the pre-IPO issue shares were 1 lakh at the rate of rupee 10, then in those 1 lakh, in respect of 1 lakh shares, the issue price would be 10. Then the company came out with the IPO of 5 lakh shares at rupee 100. So then in that respect of those 5 lakh shares, the 100 would be the cost of acquisition. And then preferential allotment at say 150 rupees. So in respect of balance shares, 150 rupees would be the issue price, cost of acquisition. Accordingly, this is how the FIFO is applied.
Okay. Miss Sir Om Prakash, if the company has different type of shares, whether permission of other shareholders is required for the value to be paid?
Variation of class right, it is more, if it has impact on the value of the shareholders, yes, approvals should be taken.
I think if it is put to the shareholders vote, I believe all the shareholders will be participating.
It will not, it may be separate class meetings also if different classes are there. Generally, in case of closely held company, shareholders agreement provides special rights to each class of shareholders, and accordingly you have to work. You have to see what are their rights. In case of buyback of share, prior approval is required in most of the share purchase agreement. So yes, to go.
Yeah, in case of private company, if acceptance is given and tendering of shares is done after the offer period, can those shares be accepted? I think generally not. In case of closely held company, but you can come out and still make an exception. Mr. Aditya Bansal, whether shares sold by a shareholder in the open market, how he would know that whether the shares are sold to the company or to anybody else, or is there any separate window on which you tender shares in the open market?
In case of open market buybacks, you get a message. Let's suppose you sell 10 shares in the market, and like any other buyer, the company is also standing.
Charu, mute yourself, please.
Yes.
I'll repeat again. For example, you sell 10 shares in the market, and like any other buyer, normally in the market, the company is also standing to and has placed a buying bid. So your shares may go 5 shares to the company or 5 shares to other buyer. So the portion for which your shares have gone to the company, you will get a SMS, because when the company places its bid, it places in a particular code, and your shares when go to the company, it matches that code and you get a message. The NSDL CDSL has this mechanism. You get a message so that you can know that these many shares I have sold, these many went into the buyback, and I can claim my exemption from the tax on these shares, and the company will pay the tax, and partly shares I have to pay accordingly the tax I have to pay.
But now to add to Tushar, but now as we have discussed
There is a
that we
window
have to take
mechanism.
the window, so it would be easy to see the tendering, the shares which have been purchased in the open market.
Okay. So Ms. Divya has asked, lenders NOC required in case of private companies? No, it is not required. If Ms. Asmita has asked, if company has made a subsidiary company in USA and purchases 100% of its shares of this company, then when I have to show the share payment in balance sheet and investment or others, I don't think it is relevant. But yes, if you making an investment, it will appear in the balance sheet. I think Asmita, please clarify your question. Mr. Dhirendra, my buyback approval, but master data not updated. Please take note, Mr. Bhupendra, Dhirendra, the master data will be updated from the annual return, not the SHA 9. Okay. Tushar, Mr. Aditya has asked if message not received, whether any other method to know shares are sold in open market or in buyback?
If not received, that means it has not gone into buyback. But now the Windows concept has been introduced, so you will know the shares have gone in.
I'm still not audible to lot many. I'm very sorry. I'll try to look into the issues next time.
Very much unlike Ankit.
So we have done all the questions that were posted on the chat box. There were certain questions that we received offline, but I believe almost all these questions are covered in what we have replied today. So thanks everybody for joining in such good numbers today, as always. And thanks to our panelists. And I'm happy to announce that next webinar is when we are celebrating our 3rd anniversary. So while we did start in an unfortunate period of COVID in the year 2020, but I think the journey has been superb thereafter. And it's all because of your positive support and encouragement. We continue to deliver on our Friday promise every week. And we look forward for your participation in the 3rd anniversary webinar. That's the 125th webinar. And we have chosen a very important and topic of how to reduce burden of court cases in India, relevant for today. I don't know whether we are able to give any solution. It's a problem in my life, I will be able to see any solution or not. But we have a very eminent panelist to be there and to participate. And I welcome all of you, as always, to be joining us in huge numbers. And we look forward for your presence in the 3rd anniversary webinar next Friday, 28th April, same time, same place, and we'll see you then. Thanks everybody for your participation.